Hey there, investors. Today we're diving into a true hidden gem in the world of stocks, Lincoln Electric Holdings, or as it's known on the market, LECO. Now, this isn't just any company, it's a global leader in welding and cutting products, and it's been making waves in the stock market for nearly 30 years. If you're looking for a stock with long-term growth potential and a strong dividend history, stick around because this just might be the one for you. LECO is a giant in the welding industry. They've got it all, from welding machines and consumables to robots and automation solutions. Plus, they're known for providing top-notch technical support and training. But here's the real question: is LECO a winner? Let's talk numbers. Since going public almost 30 years ago, Lincoln Electric has delivered a jaw-dropping total return of nearly 4,400%. That's a compound annual growth rate of 13.8%. To put that into perspective, any stock that outpaces the average market like that is definitely a winner in my book. But here's where it gets interesting. The last 10 years have been a tale of two halves. From 2014 to early 2020, the stock was pretty flat, up just 2%. But then, as the world started bouncing back from the pandemic, LECO took off. It went from around $60 in March of 2020 to nearly $120 by the end of that year, doubling in just 9 months. And the momentum didn't stop there. In 2021, LECO climbed another 23%, finishing above $140 per share. Even 2022 saw a gain of 10%, and in 2023, the stock surged 50%, closing out the year over $215. All in all, we're talking about an 11% compound annual growth rate over the past decade, with a total return of 185%. But what about 2024? Well, the stock has taken a breather, dropping 9% this year, potentially opening a window of opportunity for savvy investors like you. Let's shift gears to LECO's dividend performance, because we all love a solid dividend payer, right? Over the past 10 years, LECO has consistently grown its dividend, averaging 11.55% growth over the last decade. Earlier this week, they announced a 5.6% increase, bumping their quarterly dividend to 75 cents per share. Sure, it's a bit lower than their usual, but with a low payout ratio of 27.7%, there's room for more increases down the road. Now, here's the big question: is LECO a good buy right now? LECO ticks all of the right boxes when it comes to quality. Revenue per share has grown steadily at 7.7% annually over the last decade. Their gross profit margin has remained rock solid, even during the challenging pandemic years. And their return on invested capital, or ROIC, has stayed healthy, bouncing back to over 20% in the last 2 years. So how does LECO look in terms of value? According to my custom valuation tool, LECO is currently trading at a slight discount to its fair value. In 2023, the stock returned to the strong buy range thanks to a massive 87% increase in free cash flow per share. And while it stumbled a bit in 2024, that dip could mean a great entry point for those looking to add this quality stock to their portfolio. With a long-term expected return of 17.53%, including a 1.55% dividend yield and a 15% expected earnings growth rate, LECO has a lot going for it. This is a company that knows how to grow, knows how to reward shareholders, and might just be undervalued at this very moment. So, is LECO a stock worth watching? Absolutely. If you're looking for steady growth, a reliable dividend, and potential for future gains, Lincoln Electric Holdings might just be a stock to add to your watch list in 2024. If you would like to receive more stock updates from me, consider subscribing to my newsletter, Quality at a Fair Price. And each Thursday, you'll receive a free stock review. There are additional benefits sent to paid subscribers, like access to our entire investable universe that includes live valuation updates, a free cash flow valuation tool, and 3 model portfolios that, in my opinion, are well worth the $5 monthly membership, but you can decide for yourself. Make sure to hit that like button and subscribe for more deep dives into dividend stocks and market opportunities. Until next time, keep investing wisely and stay tuned for more stock insights. See you soon.